VIX shifting higher today, and what does that signal for investors? Yahoo Finance's Jared Blikre on the floor of the New York Stock Exchange. He's got the details. Hey, Jared.
Hey, let's get wonky with some options talk here. That's because the VIX is derived from S&P 500 options, and I'm looking at the VIX on the Wi-Fi Interactive here. This is going to be a 3-month chart, and you can see over the last few sessions here, we've picked up, but not a lot. You can see we haven't even come close to hitting that 20 plus level that we hit in May. And if we take a look at the year to date, farther away still from those heady levels, those lofty levels above 30 that we saw around the internet banking panic. So nothing too concerning yet, but we are approaching that time of year when the VIX does pick up. So here's a picture of the S&P 500 year to date. Just want to show, this is going to be important in a minute or so. We have weakened, we started weakening about 10 sessions ago, 8 to 10 sessions, and that's an important time frame that I'm going to use to track some of the sector action. First, I just want to show that VIX seasonality chart that I was talking about. We can plot the average VIX movement, and it's this white line here. You can see it peaks in February, March, it declines into July, it spikes into September, October, and then it declines again into the end of the year. That's when you get that Santa Claus rally. Right now, we are right here. So we are right at the beginning of that next potential up leg in the VIX, which usually means downward prices for equities, and this persists into September, October. That is prime crash time for the S&P 500, just because historically we've had a lot of crashes. Now, you compare that with the average returns in that period, it's a different story. The crashes don't outweigh the benefits of holding through September, October, so it's actually a pretty good couple of months to hold stocks through, but caution is warranted. Now, I mentioned before the 10-day time frame. I just want to show what's happened in the sectors since we hit that peak. Communication service is the only one in the green. That's a Meta and Alphabet story. At the bottom, we have utilities, tech, real estate, and materials all in dark red. Utility is very interest rate sensitive. So is tech and real estate for that matter. And materials, that is a soft or strengthening dollar story. When we take a look at some of our leaders here, we're only seeing green in what? Cannabis, that's its own animal, defense stocks, regional banks barely positive, home builders barely positive. But we've seen a lot of the fringier sections of the market sell off. And that is very evident when we take a look at meme stocks here. And we can see a number of names, not the least of which is GameStop. GameStop down almost 11% over the last 10 days. These are stocks that had been spiking over the last month or 2 months, kind of late to the party, you might argue. But in that sense, the fact that they're coming down right now, probably a return to normalcy, because a lot of these guys got a little bit carried away in terms of their multiples. The bottom line is we are heading into a seasonally volatile period of the markets here. We are coming from overbought levels, so we are a little bit too strong and we need to work some of that off. And that's what we're seeing right now. It's still summer, and it's going to be that way for another few weeks, guys.
Thank goodness. If only it were longer.
Yes.
Thanks so much, Jared.